Dividend investing. You've heard of it, right? It's one of the most popular strategies out there, especially when you're just getting started. And the promise? Oh, the promise is so tempting. Just buy some shares, sit back, and get a piece of the profits year after year.
I mean, who wouldn't want that? It sounds like the absolute dream. And it feels credible too. Even the legends, guys like Warren Buffett, use this exact strategy to rake in billions. It really does seem like the perfect, foolproof path to financial freedom.
But what if I told you that for a beginner, for someone like you just starting your journey, focusing on dividends could be one of the single biggest errors you could ever make? A silent, hidden mistake that might be strangling your growth and costing you thousands, maybe tens of thousands, in lost opportunities down the road. Let's dig in and find out why.
To really see why it's such a potential trap, we first have to understand the myth itself. So what exactly is this whole dividend investing thing?
Okay, so the idea is super simple. You buy a small piece of a company, and as a little thank you for being a shareholder, the company sends you a small cash payment out of its profits. It's kind of like owning a cow, right? You don't sell the cow, you just take care of it, and in return, you get a little bit of milk every day. It sounds so logical, so safe. So what's the catch?
Well, here's the thing. When you're just starting your investment journey, you don't actually have a big, productive cow. No, you have something very, very different.
Your starting portfolio, it's much more like a small, weak calf. And what's the primary job of a calf? It's not to be milked for a tiny bit of income. Its job is to grow into a strong, healthy cow. If you start milking the calf, you're just going to stunt its growth.
Let's put some real numbers on this, because it's almost comical. Let's say you start with €1,000. The historical average dividend for the S&P 500 is about 2.75%. You know what that gets you? €27.50 for the entire year. I mean, that barely covers a pizza. And this is the whole point. Chasing a few euros in dividends wastes the most precious time you have as an investor, the beginning. Your number one non-negotiable priority shouldn't be generating tiny bits of income. It should be aggressive, unapologetic growth, period.
But wait, the problem actually gets worse. It's not just about tiny returns. Chasing dividends when you're new to the game can lead you straight into some really common and very costly traps.
Okay, one of the biggest mistakes is falling for what's called the high-yield trap. You see a company offering a 6, 7, maybe even an 8% dividend, and you think, jackpot, I've found a gold mine. But more often than not, an unusually high dividend isn't a prize, it's a massive red flag.
So how does this trap actually work? Well, it's pretty simple. It starts when a company is in trouble and its stock price just falls off a cliff. Now, because the yield is calculated by dividing the dividend by the stock price, a lower price makes that yield percentage look huge. And that's what lures unsuspecting investors in right before the troubled company is forced to cut or just cancel the dividend completely. Ouch.
This brings up a really critical question. I mean, what good is a 3% dividend if your main investment, your capital, has dropped by 20%? When we invest, we have to look at the total return. That's the dividend plus or minus whatever happened to the stock price. I mean, look at companies like Intel or Verizon. Sure, they've paid dividends, but over the last few years, those little payments haven't come close to covering the huge losses in their share prices.
And that leads us to the biggest, most invisible cost of all when you choose dividends too early in your journey, the one that doesn't show up on any statement.
It's called opportunity cost. And here's what it means in this case. Companies that pay out big, stable dividends are almost always mature, older businesses. They've kind of run out of exciting ways to grow and reinvest their cash, so they just hand it back to shareholders. By choosing them, you are actively choosing not to invest in companies that have enormous growth potential ahead of them.
And the difference in that potential is absolutely staggering. Just look at this. On one side, you have a growth compounder like Microsoft. It reinvested its profits and delivered a jaw-dropping 1,600% return over 12 years. On the other side, a dividend aristocrat like Coca-Cola, a fantastic, legendary company. But it delivered less than 300% in that same time. You see? You didn't lose money, but you gave up the chance to multiply your investment over and over again, all for a tiny 2 or 3% annual check.
So how do these growth companies create such incredible returns? Well, it's because they protect the single most powerful force in all of investing. You know, it all comes down to something really boring but really important: taxes. When you get a dividend payment, you have to pay taxes on it that same year.
We're talking 15, 20, sometimes 30%, depending on where you live. You are literally taking money out of your investment and handing it to the government every single year. But with a growth stock, your money stays in, growing, compounding, totally uninterrupted. You only pay tax once, way down the line, when you decide to sell.
Focusing on dividends at the start is like trying to build a giant snowball as it's rolling down a hill, but you keep stopping to poke holes in it. You are actively fighting against the one true superpower every long-term investor has, the magic of uninterrupted compound interest.
Now look, this doesn't mean dividend investing is always bad. Not at all. It's a hugely popular strategy for a reason. It's simply about using the right tool for the right job and, most importantly, at the right time.
The main takeaway is really simple. Don't invest as if you're already wealthy. A beginner's goal is wealth accumulation, not preservation or income. Your focus has to be on finding those compounder companies that reinvest every single dollar to grow bigger and faster. And just look at the difference it makes. A 3% dividend on a 100,000 euro portfolio, that's 3,000 euros a year. It's nice, but it's not going to change your life. But that exact same 3% dividend on a 3 million euro portfolio, now we're talking. That's 90,000 euros a year. A fantastic salary, completely passive. See? Dividends become a powerful tool after you've done the hard work of building your capital. That's when you finally get to milk that big fat cow you've spent years growing.
So you have to ask yourself, is your strategy focused on growing that small calf into a massive bull, or are you content just collecting the crumbs along the way? The choice you make today could be the difference of thousands, if not millions, in your future.